indices actually should come into effect today with a games workshop, St. James's Place, and investment trust Alliance Witan joining the blue chip FTSE 100. Richard Stone is the CEO of the Association of Investment Companies, which is a trade association that represents investment trusts. Richard, good morning. Good to have you on the show.
Absolutely. Thank you.
Perhaps just explain to us how important the reshuffle happening today is.
The FTSE reshuffles the top 100 companies every quarter to make sure that it represents the 100 largest companies in the index. It's important to investors, particularly those who follow tracker funds and things which invest in the top 100 companies. It's also perhaps indicative of the nature of the UK market and which companies are doing well and where the size of companies is. So it's really good to see another investment company going into the top 100. That makes 5 in total now. So.
Yeah, which is actually a record I was looking at.
Yeah,
explain also the importance of that.
The importance of that for investors is that an investment company gives them exposure to a basket of investments. It's a diversified portfolio managed by an active fund manager, so it helps diversify the investor's portfolio. For the sector as a whole, clearly it's good because it creates additional demand for investment companies, and it brings them to the fore in terms of investors' attention.
Now let's look at the less positive news going on when it comes to the London stock market. This reshuffle happening today is coming at a time when we have seen the numbers showing a large exodus from the London stock market. I was just wondering, really, what is the outlook here? Do you see any sort of, incoming changes that could actually change the narrative for the FTSE and the others?
Yeah, I mean, if you take a look at the market as a whole, there's quite a lot made of the number of companies that have left London or delisted. That's not a UK-specific problem. The number of companies that are listed on the public markets globally has shrunk significantly since 2008 and the global financial crisis. The government and the regulator are taking steps to change the listing rules and make it easier for companies to list, easier for them to raise capital. They're looking at the prospectus requirements when companies raise capital. So they're trying to do things to invigorate the market. The LSE has an initiative that's opening up potentially access to more private companies as well. And one of the great things with investment companies is that they are able to invest in both listed companies and unlisted companies. So they can give you exposure to some of those private assets, real assets, things that investors can't naturally get access to through the public markets. They can bridge that gap between the public market and those private assets. So.
You say that it's not a London-specific problem. However, there's clearly a lot more attractiveness in US stock markets, right? You have higher valuations, just higher capital options. What I would like to understand is whether the measures that you just highlighted there will be enough and will come into place quickly enough to make London more attractive and more competitive with Wall Street.
It's going to make it more competitive. Will it be enough? Who knows? Let's wait and see. I mean, I think that a lot is made of the US market, but clearly returns have been very heavily concentrated in the Magnificent Seven, and in some instances, one would say over the last 12 months, sort of more like the Magnificent One or Two. So, and that sucked a lot of capital into the US markets. But yeah, I think London still has a great future and good prospects.
We have also heard the government say that they want to regulate for growth. That was the tagline. What do you think that will actually mean?
I think it's interesting when you look at the new government coming in. There was quite a lot of optimism around their growth, investment, wealth creation sort of agenda. I think that what you've seen subsequently is relatively anemic growth. The Bank of England was warning on that again yesterday. Investment being more government investment rather than private investment. But I think when you look at the public finances, you look at what the bank is saying, it's clear the public purse can't do all of this. So the government is going to need private capital in order to deliver its ambitions, whether that's in the net zero transition, infrastructure investment, or wherever it might be. So to that extent, they've got to support the markets. They've got to support the crowding in of private capital from pension funds, institutions, as well as retail investors into those investments in order to deliver on what they want from a growth perspective. They can't do it all themselves.
Right. I just was wondering also whether you see a potential risk here from deregulating, because ultimately that's what we're talking about here, right? When you think about the progress to some extent that we have witnessed since the global financial crisis in terms of regulation, is it actually the right approach to cut this, given everything that we've been through?
I think there's these things are like pendulums, aren't they? They go one, and I think potentially the pendulum has gone slightly too far in that direction. And I think one of the things that's being talked about quite a lot is that, and the regulator has talked about this in various sessions with the Treasury Select Committee and others, that we need to put a little bit more risk back into the system. There's a risk aversion which is preventing people making those investments, sitting in cash too much, too long. We're not getting the returns in our pension funds and elsewhere that we should be. So actually a little bit of deregulation and taking some of those brakes off a little bit is probably a good thing in that sense.
Let's see what will happen, what they will do, practically speaking. We appreciate your time this morning. Richard Stone, CEO of II.